If you own an investment property, you could be tipping the ATO an extra $3,000 to $10,000 every year without realizing. One client improved their after-tax outcome by $230,000 over the hold by fixing records, loan structure, and sale timing. So if you're an Aussie landlord or about to be, this is for you. Today, I'll show you the exact steps to minimize tax and keep more money in your pocket legally. Hi, I'm Rasti Vaibhav, your independent buyer's agent. After hundreds of strategy reviews, I built a proven playbook that turns investment property into a tax-efficient machine. Quick note before we dive in. I've made a free property tax readiness workbook for you, an interactive checklist with quick formulas. Download it via the link below. Here's what we'll cover in this video. Negative gearing done right, depreciation you can actually claim, and clean loan structure, and then how to plan CGT from day one. First, the golden rule. Buy for growth and cash flow. Use tax to optimize, not justify the deal. Don't spend $1 just to save 47 cents in tax. Buy great properties for growth, then use tax rules to boost your returns. There's a trap most high-income investors miss. I'll show it in next 60 seconds. First, negative gearing in plain English. If your property costs more to run than it earns, that loss can reduce your other income tax. Example, a $10,000 rental loss at the 37% bracket is about $3,700 less tax. For high earners, this is a big win. Most of the benefit actually skews to higher incomes. The key is making sure every dollar is claimed correctly. Get a property-focused tax accountant early, ideally before settlement or major renos, so claims and structure are set up right. They will make sure you don't miss a cent. Don't do this alone. Get specialist help early. Recap, negative gearing means less tax if your property makes a loss, but only if you claim everything right. Now, let's hit the two biggest deduction areas where a specialized team makes all the difference. Depreciation is like getting a tax refund for your property getting older, even if you didn't spend that money this year. Get a quantity surveyor to prepare a depreciation schedule, ideally at settlement or after renos. It's a one-off, low cost that often pays back quickly and keeps delivering annually. Without it, you're giving money back to the ATO. So don't skip this step. Recap. Depreciation is a non-cash win. Don't leave it on the table. Now let's protect the big cash deduction, interest. Interest is your biggest tax deduction, but mistakes can cost you. Here's how to keep it clean. Never mix personal and investment spending. Avoid loan contamination. Keep offsets, redraws, and lines of credit purpose specific. Keep your loan statements tidy. Always check with your accountant before moving money. Think of it like pouring coffee and orange juice into the same mug. Once they're mixed, you can't separate them. Get your accountant and broker on the same page before you buy, redraw, or refinance. Keep your records clean. A little effort now saves you big headaches later. Recap. Clean loans mean bigger deductions and less trouble with the ATO. Annual deductions are only half the story. The sale decides your real outcome. Let's plan capital gain tax on day one. If you sell for a profit, you may have a capital gain. Hold for more than 12 months and you can get a 50% CGT discount. Structure matters. Personal, trust, company, or SMSF. So get advice before you buy or renovate. Smart investors plan CGT early. Sometimes it's better to borrow against your property's growth instead of selling. So you delay the tax. No sale, no CGT event. It's like pressing pause on the tax bill, deferring it until the timing suits you, not dodging it forever. Think of CGT planning like chess, not checkers. The best moves happen early. Always talk to your accountant or planner before you make big moves. Planning early saves you stress and money. Model 3 scenarios with your team. Hold for tax and cash flow, refunds for equity release, or sell for after tax proceeds and timing. Especially if you're changing your home to an investment, doing big renos, or planning for retirement. Recap. Plan ahead, keep records, and know your options. Hold, refinance, or sell. Here's how those moves stack in real life. One client improved their projected after-tax position by $230,000 over the hold with a depreciation schedule, clean loans, and early CGT planning. It's not magic. It's having the right team and plan. You can do this too. You've got a playbook. Let's put it to work this week. Most investors use a general tax agent. On the other hand, properly focused specialists catch patterns others miss: depreciation, loan structure, CGT timing. You need an A team, accountant, quantity surveyor, and broker working in sync for you. As your independent buyer's agent, I don't just fund investment-grade property. I align the right specialists around your plan so you maximize returns and minimize tax legally. Over the next 7 days, order your depreciation schedule, audit loans for contamination, and map your hold, refi, or sell triggers. If you want extra help, download the free Property Tax Readiness Workbook below. Then book your free 15-minute property tax check-in. We will review your structure, spot deduction, and loan contamination risks, and map your next 2 moves. If helpful, I'll also introduce you to my own A team. Don't leave money on the table. Keep more of what you earn. Thanks for watching. See you in the next one.